So when is the housing market going to crash? Would it just do it already? Well, no one's got a crystal ball, but everyone's on pins and needles about when this market is going to crash so that we can all swoop in and take advantage of it. Well, I can't tell you exactly when it's going to crash, but I can tell you there are some indicators that I think are worth watching. So that's what I'm going to talk about today. So to really hold off the housing market crash, all you need to do is just hit that like button. It'll recapitalize markets. It'll bring jobs back. It'll make everything better. So just go ahead and hit it. Thanks. So when is this market going to crash already? Everyone seems to be waiting for the other shoe to drop. Just looking at the markets now and comparing it to 2008, which is really fresh on everyone's mind. We've got really high housing prices and we've got an all-time high stock market, yet we're still in the middle of the pandemic with no end in sight for that. And unemployment is at incredibly high new levels, but everything is doing rosy fine if you own homes and stocks. So what's up? Like the spidey sense is going off saying just, hey, disaster is coming. So is it really coming? What I'm noticing is that commentators like myself and anyone else predicting a housing crash tend to look at just a couple of levers or sometimes only one and say, hey, if this is happening, then hey, we're going to get a housing crash. And so one of those, for example, is the forbearance and foreclosure rates. So all of these mortgages are in forbearance and at some point will be foreclosed on. And so once that foreclosure wave hits, we're going to have a lot of inventory, and then that inventory is going to create a lot of supply, which is then going to push prices down. And then we're going to have, this bonanza of super cheap houses because all of that inventory is going to show up. Well, if you look at just the one lever, that's a reasonable, theory to make. And if that were the only thing influencing housing prices, then yeah, it kind of makes sense. However, I would argue that it's incomplete. There's a lot more to look at than just foreclosures. Now, I've got 7 levers that I'm going to go through today and show you what I think that they're going to do and how they're going to influence the market, but no one of them will single-handedly move the market by itself. So you really kind of have to look at all of them at once and figure out which one is going to impact the market sooner or later than others. So kind of like which hen is going to come home to roost before the other one, which I think is what will ultimately steer the market toward wherever it's going. The first one certainly is foreclosure inventory. Right now, a lot of loans are in forbearance. There's something like 20 million homeowners are having trouble making their home payments. Now that means that they are in forbearance, but not necessarily being foreclosed on yet. So it really depends on when those foreclosures start. So if they started, next month, then yeah, we would see a bunch of inventory show up. But if they don't start for 12 months and the economy recovers and people are able to resume paying their notes, then maybe it won't be as bad. So it really just depends on when that hammer falls as to whether or not we're going to see a big spike in inventory. So we could see it over the next 12 or 18 months. Maybe it'll happen, but it's hard to say like, yes, this is the only thing that's going to happen. But it's definitely worth considering, and we definitely want to keep an eye on it. And I would say that having foreclosures show up in the market is going to produce a downward pressure on prices because it's going to put more homes out there for people to buy. So if you've got more supply, then prices have to come down. Okay, the second one, and probably the most important lever, is jobs, because that's where people get money to pay their mortgages. Right now, our unemployment is still crazy high. It's at record levels. It has recovered from the initial spike when the coronavirus first hit, but we still need like 11 or 12 million jobs to get back to a normal rate of employment. The other problem that you have is that businesses are right on the edge or are shutting down. And even though you could say that's almost kind of a separate category, but I mention it here because it is related to jobs, because businesses employ people. So with all of these businesses going out of business, well, guess what? They're not hiring people, so that means no jobs. Now, once the coronavirus pandemic passes, I imagine a bunch of those businesses may start back up or come back to the table, although we don't know how fast that's going to be. You've also got another problem with the top companies are becoming kind of what I call zombie companies, and this is a not so literal financial term, meaning that the debt load that they are taking on is making it such that the revenue that they are making is just covering their debt. So they're not really making any money. They're just kind of holding water financially. And this is kind of a separate problem, but the reason I mention it again is because when you've got these companies that are just like barely hanging on to their balance sheets, they're at the edge, and if they tip over, well, then you're gonna lose all of the jobs that go with that company. So I wrapped up a bunch of those under one big lever, which is jobs. But at the end of the day, you've got to watch the unemployment numbers because you have to have people who are working to be able to afford their payments. So for all of those people that have lost their job during the pandemic, a bunch of them have moved in with mom and dad, or maybe they're doubling up. Homelessness has certainly gone up in a lot of places, which is really, really unfortunate, but we really need to see the job numbers continue to improve. Now, they've improved in the short term recently, but they're just slowly eking up. We're still not there yet. We have a long way to go before the jobs market is what I would call stable. The third lever is money printing. So the government has been printing money at an incredible rate. I've got a really great chart here that shows the 25-year history of money printing in the United States, and you can see there's this massive spike, right? That is not a good thing. So once you've printed that much money without creating more value in the economy, like the money can only devalue. So it's kind of this illusion that's holding things up right now. A lot of it is in equities and in real estate too. So as long as people are buying things that aren't on Main Street, then it looks like everything is okay. But at some point, all of that money printing is going to have to create inflationary pressure. Now, we don't see it yet, but it could be coming. So in an inflationary environment, if that were to show up, which I think is possible, it's one lever for sure, then prices are actually going to go up. So real estate is an inflation hedged investment. So we could see prices actually increase if you had really high inflation, because a house in a particular location, you can't make more of them. It is what it is. So if you've got more money in the economy, then the price of that house is just going to go up by the fact that you have more dollars. The fourth lever is interest rates. Now, the Fed is saying that interest rates are going to stay low for years to come, which they will certainly do. And that's going to put pressure up on prices, because the lower interest rates are, the more house you can afford. So buying a $300,000 house with a 6% loan versus buying a $400,000 house with a 3% loan, the $400,000 house is probably going to be cheaper per month to own than the $300,000 house with the higher interest rate. So low interest rates are certainly going to stimulate the economy, and as long as the Fed keeps them low, that will translate into low mortgage rates too. They're not directly linked, but they certainly influence each other. And so those low interest rates will certainly put upward pressure on housing prices. Okay, the fifth lever is housing supply. It is currently at its lowest level ever in the United States. As long as they have recorded housing supply, it is the lowest that it has ever been measured at, which is just insane. Now, the reason for that is that most people aren't selling their homes during the coronavirus. They're working from home, and they're actually improving their homes because they're just kind of camping out. So once the virus has passed, or once we find a solution to it, I think you may see a big uptick in people selling their homes because maybe they improve them so that they could live in them while they're working from home. But right now, with such a low supply, that's also going to increase prices, simply supply and demand. If you don't have as many houses to buy and you've got more buyers than sellers, well, that's only going to push prices up. So again, it's a lever. Now, as I talked before, when you have all those foreclosures show up, that might potentially put more inventory, but it's a matter of like, well, hey, did those foreclosures show up during the pandemic or after the pandemic? That's a real critical question, because if they show up during the pandemic, well, then maybe it just evens out the market and we're okay. But if it shows up after the pandemic, once people feel safe to go out again, well, then now you've kind of got two pressure plates being pushed on, because now all of that pent up demand to sell will show up in the market because people feel safe to go out, and you've got the foreclosure showing up, so that could be a double whammy. So supply is ultimately one of the big indicators for prices. So once supply goes up, then that's going to push prices down, but since supply is currently tight, that is also pushing prices up. Okay, the sixth lever is builder confidence, which is currently at an all-time high. And now this is a measure of how confident builders are that what they build will get sold and their ability to make a profit on those new builds. And so building actually slowed when the coronavirus showed up because you had all these lockdowns, and so not as many buildings were getting done. We were already having a shortage in housing supply going into the coronavirus, and when you add on top of that the fact that building slowed, it further tightened the environment, and you've got no one wanting to sell because of the virus, which further tightens the environment. So right now, builders know that if they put a brand new house on the market that no one has ever lived in, and the fact that there's low supply, someone is gonna buy that baby. So I would say that that is going to actually put downward pressure on prices because builders will build more homes. Now, they have to be able to build at a rate which exceeds the demand. But if you're a builder right now, things look good. You want to get as many houses on the market as you can, make hay while the sun is shining, because there is a ton of demand and there's just not enough supply. So it depends on how quickly they build and where in that build curve where they expand the inventory, the other levers that we talked about come into play, like whether or not those foreclosures show up or whether or not the coronavirus ends and creates new supply from people selling their homes. This is one more lever. It's not just one thing. This one certainly adds to it. Now, there's something else I want to show you, which is lumber prices. Now, just a little while ago, just actually a couple weeks ago, lumber prices peaked at an incredibly high number. Like if you look at this chart here, there's like a 20-year history of lumber prices. I'm sorry, a 5-year history of lumber prices, and you can see you got to $900 per board foot. Now, we've come back from that, but for a time there, it got a lot more expensive to build the most common component in a home, which is lumber. So right now the pricing is at where we were kind of when we hit this little spike in 2018, but that is certainly going to be a big factor in build costs because, hey, if the builder has to spend 20% more on the cost of goods, they're going to put that into the house too, which would in theory raise prices simply out of the fact that, hey, they've got to pass those costs along to the consumer. So again, it's another lever. That one doesn't, move the market by itself, but it's something to think about. Okay, and the last lever I want to talk about is where people are moving. Real estate is always a local market. And so you hear a lot of national numbers that says like, oh, the sky is falling here or the average rate is XYZ. It matters and it doesn't matter because the Austin market is going to be very different than the San Francisco market or the New York market or the Miami market. So you really have to pay attention to what's going on in your area. So the top 3 states that are losing people are New York, Illinois, and California. And where are they moving? They're moving to Arizona, Florida, and Texas. So all that migration is going to cause, a more supply and demand to shift. So the supply in theory would go up in the states where people are leaving, and the supply would go down in areas where they are moving to. So do you think that I missed a lever? I would love to know your comments below if you think I missed one. Okay, so how does Austin fare with all of these levers to pull? Okay, well, the first one, foreclosures. I'm not seeing any foreclosure inventory on the Austin market right now. When I say I'm not seeing any, there might be a couple, but it's not like this big wave of foreclosed properties showing up. Our inventory is still really tight, so that's not the case or not a problem right now. Now, it could be in the next 12 months, but as of right now, no new inventory from foreclosures. Okay, so jobs in Austin are actually pretty strong. We know that 12% of the economy in Austin is in the service and retail industry, and that was the industry that was hurt the most by COVID. The rest is pretty well diversified amongst medical, government, and IT, to name a few. So Austin actually is going to do pretty well, I think, compared to the nation because most of the jobs, especially where people are buying homes, are in sectors that weren't as affected by COVID. Okay, money printing and interest rates, those are national issues. They're not specific to Austin, so they're going to have upward pressure no matter where you are. Housing supply here in Austin is also still really low. And when it comes to builder confidence, I would say that it's high. There is building going on in Austin. However, the permitting took a big dip earlier this year. So not as many new construction permits were being issued. Also because the city is having a hard time turning them around because they're on COVID restrictions. So they take a little bit longer to do everything. So if you can't get the permits done in time, well, then you just can't build as fast. So it's taking longer to get stuff built. As far as increasing that supply in Austin, well, Austin is pretty well built out. There are not that many places left to, build large tracts of suburban homes. So you're going to see most of that in East Austin out toward 130 because there's just big open swaths of land out there. You've got all those new roads. So I think that's where you're going to see the most development. And of course, you're going to see it in sub-communities too, like Kyle and Buda and Taylor and Hutto and things like that. But in the core of Austin itself, it's totally full. It's all single family. Code Next is still dead at this point, so we're not going to see any upzoning anytime soon. I mean, maybe, but so far they haven't been able to get that through. And the last point, migration. You still have people moving to Austin every day. Its population is still increasing. So as long as the demographic pressure is higher than the number of homes that are going on the market, which is currently very low, you're going to continue to see upward price pressure. So when we do our market updates every month, check those out. But I mean, almost every time. In fact, every time for I think the past 2 years, the rates have always been increased pricing. So we'll see if that changes this month. If you like this video, pay homage to the YouTube gods by pressing the like button. Subscribe if you want to see more videos from me. I certainly enjoy making them, so I hope that you like them as well. May you invest wisely, and I will see you on the next one.